Hello, no mai, hoki mai. Welcome back to day one of the Financial Services Council 2020 conference, Generations. We hope you've had a relaxing break following our morning of insight, debate, challenge and inspiration. It was great to see people meeting and greeting the Tech Alley and Pitch Perfect participants at the 12:30 session sponsored by Minter Ellison Rudd Watts. And I heard great feedback from the Trustees Executives screening of The Final Countdown, Trusts Act 2019, and also Behaviour's session on reshaping financial advice. Those great insights just keep coming. Thank you for joining us for the next hour, where the focus of our breakout session spans right across the sector. In the insurance breakout, we have a star-studded panel discussing how we must tackle the customer agenda. And in the Generations stream, our speakers address the incredibly important topic of well-being. In the second Laduka session of the day, guests Lou and Lucy discuss how the sector can change how to support customers affected by cancer. And over on the investment channel, the conversation is all about the behaviour of switching, so topical for 2020. Once again, in all sessions, there is the opportunity for Q&A, so ask away. Enjoy and matewa.
Kia ora, and welcome to this breakout session, Locking in Losses, the Behaviour of Switching. My name is Noah Schiltknecht. I'm an investment consultant at Makao Investments, and it's my great pleasure to facilitate this session. Before we start, just a comment regarding interactions. As Vanya mentioned, for you to use the app, ask questions, share your thoughts. We want to make this as interactive as we can, given the digital format. If you want to ask a question to someone on the panel specifically, please also make sure you mention the name at the end or at the start of the question. Now, before I introduce our high caliber panel today, allow me a brief introduction. What do we actually mean by locking in losses? If I could have the first slide up on the screen. So, simply put, it's the opposite of what makes investing work in general. Rather than buying low and selling high, locking in losses really means we sell low and we buy high. How does this work in practice? Well, it does happen with KiwiSaver members and also in workplace savings schemes, that when markets crash, some members switch from the riskier options like growth and balance to less risky options, cash and conservative. While this might be fine in theory, the problem is often that if those members don't switch back, they miss the rebound in markets, which typically occurs after a crisis. And we have seen this year that such a rebound can be extremely quick as well. It took only 3 months for equity markets to recover from their lows in March. So as a result, if they miss the rebound, they lock in losses. It's important, however, to point out that this is not about blaming people for making certain decisions. We'll see today that it's perfectly normal to have such a reaction. It's simply part of human nature. That's what we'll discuss in the first part of this session. We'll then hear some insights from the panel on how much of an impact it has. How many members do actually switch possibly at the wrong time? And what sort of dollar figures are we talking in terms of the losses they locked in? And then most importantly, in the third part, we'll look at potential solutions. What can we do? What can providers do to help avoid these issues in the future? To discuss all of this, I can rely on the insights and suggestions of a great group of experts. And it's my great pleasure now to introduce the panelists for today's session. In no particular order, as you can see on the screen, going from left to the bottom right, we have with us Jonathan Beale. General Manager of Wealth and Insurance Distribution at ASB. Jonathan has been in financial services for over 25 years, and at ASB, he's accountable for the advice and distribution of all wealth and insurance products. Jonathan has been with ASB for nearly 15 years, and in the past also held roles at Westpac, AMP, and with Lloyds Bank in the UK. Jonathan is a passionate leader of people and prides himself on being 100% customer-centric. Jonathan, great to have you here, and thank you for sharing your insights with us today. Next to Jonathan, we have Gillian Boyes, Manager Investor Capability at the Financial Markets Authority. Gillian has an extensive background in marketing, communication, and human resources roles across major banks and financial services organizations, and has also consulted to multiple government agencies. As the manager of the FMA's Investor Capability Strategy, she runs a work stream delivering in-depth understanding of how investors behave and make decisions. Gillian, welcome. It's great to have you on the panel.
Thank you.
We're also lucky to have Henry Tong, the CEO of Generate, with us. Henry has 2 decades worth of experience in financial markets, beginning as an equity analyst for a New Zealand stockbroking firm, before moving to London, where he worked for Credit Suisse and Abbey National. He returned to New Zealand in 2003, worked in investment management and as a portfolio manager, and co-founded Generate in 2012. Henry, welcome to the panel. Thank you for sharing your expertise with us today.
Thanks, Noah.
And last but not least, we have Hugh Stevens with us, the CEO of NZX Smartshares. Hugh joined the NZX in 2018 with extensive fund management industry experience gained in New Zealand and abroad. Hugh is the former head of private equity and real estate fund services for BNP Paribas in Paris, France, and also worked for JP Morgan in London, where he held several executive roles. Hugh, it's a pleasure to have you on the panel today. Now, before I let the experts speak and share some of their experience from the turmoil we had in March and the related switching, I want to spend a little bit of time on talking about the drivers of switching. Why would one decide to sell low and buy high? And a lot of the answers are found in behavioral biases. If we can move back to the slides, please. I'm not sure they're up now. So why would you lock in a loss? What are some of the biases, and why do investors have biases? Hopefully you can see the slides now. So we learn in economic theory that people make rational decisions. However, this might be correct if we look at aggregate outcomes, but if we look at individual decision making, you will find that investors are affected by a number of biases. And why do we have these biases? Well, it's simply because our brain is just not a perfect machine. It's affected by a number of flaws, flawed perception, selective memory, superstition. There's a lot of things that affect our thinking and our decision-making that are not rational. And a lot of those affect switching that we see in member investment schemes. Now, what are some of the biases that contribute to switching? The first one that I'd like to talk about is a well-known one, recency bias. We have a tendency to give more weight to what happened recently. And this leads to decision-making, which is a bit like driving by looking in the rear view mirror rather than at the road ahead. So if we are in the middle of an equity market downturn, we have a tendency to think that there is a problem in markets. We are worried about investments, and we worry about it more than we would over the long term. And as a result, what it means is that often we start to project the recent performance into the future. We've all heard this before. Past performance is not necessarily a good indicator of future performance. This is not just a bland and overused disclaimer statement. There is some truth in it. We have to look forward rather than look in the rear view mirror. And unfortunately, a lot of investors don't do that at times, and as a result, might make the switch. We're also a social animal and like to do what others do. Herding mentality affects investment decision-making as well. You might have had friends or people that you know come by, walk past your garden during the lockdown. You might have heard, like I did, from some, oh, I just switched my KiwiSaver into conservative. If you hear the same message over and over again from friends, from people you trust, you might start to think, well, maybe it's time for me to switch as well. So we like to follow others, even if at times it means going in the wrong direction. If it's not from friends, one place where we definitely heard about some of the issues in financial markets is, of course, in the media. Here are some of the headlines that we've seen during the recent downturn. KiwiSaver funds shrink by 4.5 billion. Most funds in red. First home buyer loses 10,000 from KiwiSaver in 1 week. Coronavirus and oil crash, New Zealand stocks to be rocked as markets hit hard. And worse than the GFC already, labor market may enter second wave of job losses. These headlines are not going to put you in a positive mood when it comes to investment, but it's certainly too easy. It would be too easy to just blame the media for the switching. But as we will see later on in the session, it does affect the way people think about investments. The last bias I would like to talk about is the illusion of control. We often overestimate our ability to control events. A non-investment related example of this is a plane ride. I have been on numerous flights to windy places like our lovely capital, but if it gets really bumpy, I still find myself clinging on to that armrest and worrying about whether we land safely. And why is that? Well, I'm not in control. I'm not flying the plane, and I can't see what's ahead, what comes ahead in terms of where the plane is going. And if we look at financial markets, same thing happens for some people as well. It gets very bumpy. They worry about what will happen next. They definitely cannot see ahead of what sort of returns they will have in the future. And as a result, they try and control something, which is in the KiwiSaver or workplace savings space, being able to make that switch. So we have recency bias, we have herding mentality, we have this illusion control. And this year, on top of that, we had a pandemic and a lockdown where people couldn't even decide where to go, and in some cases, what to do on a daily basis. So again, a lot of things have been taken away. Switching was one of the things that people were still able to do. So this is a bit about the theory. What are some of the biases that may cause investors to make that switch? And with that, I'd now like to bring in the panel. And Gillian, I'd like to start with you. You've done quite a bit of work on investor behavior at the FMA. Can you share some of your insights on this with us and how they relate to the issue of locking in losses?
Yeah, so thanks, Noah, and thanks for that really great introduction to some of the biases there. We put out a white paper on behavioural insights in 2016, and our particular interest was on helping improve financial capability, because we know that education by itself can't do that. And so understanding how people behave and adapting your processes and products and so on so that they better fit how people actually naturally behave can lead to much better outcomes in many cases. So that was a particular interest for us, and our goal is to help investors make good decisions. I won't cover any more of the same ground that you've covered already on biases, but I guess a key point that we made in our white paper and in some of the experiments that we've done with some KiwiSaver providers since is that the very best time to help New Zealanders make a good decision is when they're actually making a decision. And that's why it's so critical for industry to be involved in this and to be thinking about it. And it's really great that this session has been set up today to have that discussion.
Great, thank you, Gillian. And then we'll come back to education later on as well when we talk about some of the potential solutions. But now would like to bring in some of the KiwiSaver providers who have some really interesting, I guess, first-hand experience. And we've talked about the biases and I guess the emotional decision-making. Jonathan, can you share some of your experience with customers from the recent downturn?
Yeah, thanks, Noah, and great to be able to talk to everyone. I suppose I'm pretty lucky in my role. I do get to see a lot of customers and speak to a lot of customers and get a lot of feedback from the front line. But when we sort of reflect back on what we saw through sort of COVID and the crazy sort of March period, one of the really interesting things that we saw about the emotions of it was whether customers had advice or not. So and so if I sort of take the customers who'd been given advice, had a relationship with a wealth manager, they of course still had questions, they were still worried, but they were much more open to listen to what the advisor was saying, what the bank was saying. They're a lot more trusting in what we were saying and sort of going back to first principles of why they made that investment decision in the first place. If I compare that to customers who hadn't had any advice and had made a decision themselves, that reaction was very, very different. They were very demanding. They were, in some cases, actually quite aggressive and quite rude on the telephone or face to face, and wanting things to happen, and weren't particularly open to listen to what we were saying. And even, of course, you'd say that you're a bank, yeah, and you're just trying to. So a very big difference between sort of advised and non-advised. But of course, people do get really, really emotional about their investments. You know, they've worked really hard for this money. They've given up things to make these decisions and get this money. And I do remember one particular customer here in North Wharf who came in. Their husband had recently retired. He had they had quite a bit of money that he was thinking about investing, but his wife had an ASB KiwiSaver. She was in the conservative fund. She had about 30, I think from memory, about 34,000, and it dropped by about $2,500, and she was absolutely distraught that it had gone down $2,500. Her husband kept saying to her, "Don't worry, it will come back." Everyone she's spoken to and said, "Don't do anything, don't worry about it, it will come back." But actually, that's not what she wanted to hear. She wanted someone to say, "It's your money, make a decision. If you want to take it out, take it out. These are the consequences of doing it." And as soon as I was actually honest with her and said, "It's your money, you can decide what to do," you could see the relief off her face. She was very upset. She had tears in her eyes about how worried she was about it. But as soon as she realized that she could do what she wanted to do, the relief was just enormous. So I think some lessons there about advice and no advice, but also sort of getting people to understand that they do have some control and they can make the decision. And for her, actually, it wasn't the wrong decision. It was absolutely the right decision that she made.
That's great. That's a really powerful example, I guess, in terms of having control, and we'll definitely come back to the topic of advice, how much that can potentially help. Some really interesting insights there from ASB. Henry, what was your experience with customers during the recent downturn?
Yeah, thanks, Noah. I'd echo all of the other comments that Jonathan's made, and from what we've heard about biases, it was a enormous amount of inquiry, like nothing I've ever seen before. I've been working in KiwiSaver since 2007 when it started, and this was enormous. And I think it was that combination of social media, a pandemic, and computerized trading, driving markets very, very quickly. All of that created a news flow that was nothing we'd seen before, and that obviously drove a huge amount of fear and panic, and people wanted to know about their KiwiSaver. And so we took a huge amount of calls and emails and chats, and we had a lot of online switching. Online switching was absolutely off the charts. So people would go logging into their accounts and making that switch to conservative. Where we could speak to people, we had a lot of good success, but I think we'll talk about that a bit later. But it really was a reflection of the news of COVID spreading and stock markets plummeting. There was a mirror image, and that really drove behaviour. It's important to know it's not just KiwiSaver members who are making that switch. It's people selling stocks. It's people selling bonds. All around the world, people had those same biases.
That's a really good point. Yes, when we talk about switching, we might only see KiwiSaver or workplace savings schemes, but it happens with other savings as well. Hugh, what are your thoughts on some of the behavioral aspects, and I guess what's your reflection on what happened in March with some of your members?
Well, thank you for the introduction, Noah, and great to be talking about this topic. It's extremely interesting and valuable for everyone who we work for in our schemes, so that we get on top of this topic. I suppose one of the interesting things that we've noticed is that it's not just about an individual decision making, and in fact, what we've seen in our data is really that where people are making the decisions by themselves, they tend to make the worse decision in terms of the outcome than where they have someone else's hand to hold or someone else's hand on their shoulder. So I think I have a slide here, just the current slide to come up, which looks at the age distribution of switching during March. And it just shows a couple of really interesting things. And one of those is that when we make decisions for other people, we seem to make better decisions than when we're making them for ourselves. And one thing that I noticed about this chart, which you can't see, which is it's a very similar distribution to what we see in responsible investing as well, which is if there's someone's hand on your shoulder, then you tend to make more responsible investing decisions. And what we can see here is that children, young people, they tended to have a low incidence of switching during that volatile period in March, and also older age groups, they were switching less. But that age group from the sort of 18 to 35s, quite high incidence of switching. Similarly, on the responsible investment side, we see a high take-up of responsible investing amongst children and older people, and it drops quite low when people are feeling that they are making the decision by themselves through their early careers. But also, going back to your point about the herding bias, really, I suppose those younger years are where you're probably most impacted by what your mates are doing, and so therefore you're prone to a herding influence. That was what we saw.
Great, thank you for that, Hugh. Just a quick reminder for everyone, please feel free to share your thoughts through the app, ask some questions as well. I can see at the moment no questions yet, but please share your questions as well. So we've now talked a bit about why people make these decisions. How much of an impact does it actually make? We'll look at both what's the percentage of KiwiSaver members, and also talk a bit about the losses, how much have people potentially locked in terms of losses. So Jonathan, let's start with you. What's some of the insights you have from the data about switching at ASB during the downturn in March?
Yeah, thanks, Noah. I'll probably start by saying one of the things that ASB tried to do is make KiwiSaver as easy as possible to use, so you can try and do everything you possibly can on your phone, and that was always the great intention: give people control. You can add money, you can fund switch on your phone or through the internet banking. So, and we've done that for a number of years. So, and that was to give people, as I said, the control. A normal kind of switching day at ASB for KiwiSaver would be about 175 switches. Just to put that into perspective, we've got sort of 530,000 people in ASB KiwiSaver, so it's something that people do every day. And then if you look at like what started to happen in early March, we started to see the number of switches start to increase from the hundreds to the thousands, and we saw flows. We saw flows then move from the growth fund, start moving out of the growth fund, the balance fund, and the moderate fund, to start moving more to sort of cash and conservative. And that really started on about the 4th of March. And the first day we saw about 7 million go out of the growth fund, and that constantly built every day until we got to the 17th of March, which normally is a pretty good day for me. It's St. Patrick's Day and it's my son's birthday, but the 17th of March was the day that was like the big day that we saw. And we saw just over 5,000 switches of growth orientated funds to more cash and conservative funds. We saw about 100 million move out of those funds into more conservative cash and conservative funds, which was a huge day for ASB KiwiSaver. But you sort of go back and then go, well, actually, what happened after that? Once we got to the 25th of March, it completely reversed, and we started seeing money start moving away from cash and conservative funds, moving much more into the growth orientated funds. So it sort of lasted about 21 days, and then ever since that, we've been green ever since, and continue to be green. So it was a period of time. But the thing I'd leave everyone with was they sound big numbers, 100 million, thousands of switches, but in the grand scheme of things, that's 94% of people in ASB KiwiSaver did absolutely nothing. They didn't change their fund. They didn't move money around. There's only 6% of a KiwiSaver scheme that actually did anything. And so I think if we had started this and knew what was coming and said, oh, it's going to be 6% who are going to make a change, then we'd probably be pretty happy with that. At the time, it felt as though the world was collapsing, but actually, I actually think it's a pretty good result, and maybe one that we don't talk about enough, that actually 94% of people actually didn't do anything and didn't panic, and didn't make any change, and rode it out, and probably rode it out in a real positive way.
That's great to hear, and good to hear as well that some people switched back and didn't miss the rebound in markets. Hugh, you had quite a good look at some of the statistics at Smartshares as well. If you can add some of your insights and statistics with us as well, please.
Okay, yeah, sure. And if we could just go back to the slides there, I have a few charts just to spin through here. So what we can see on the chart here is just exactly what Jonathan was talking about, that the switch behavior really followed the volatility in the market. And for us, there's a couple of peaks there. I think there's one around the 17th of March that Jonathan was talking about, and then another one on about the 23rd of March, which was the low point in the New Zealand market. And of course, we have a number of members who go through our scheme into the NZX, I suppose, indices. So that makes sense. But clearly, we need to also look at what different types of schemes have experienced. And I think if I just click through into the next slide, we can see that the workplace savings scheme, which is employer-sponsored schemes, actually had a lower level of switching. So where there was someone with their hand on your shoulder, I suppose, again, there were, I suppose, more senior employees around you in the same scheme, then it tended to suppress some of that desire to switch. And then if we click through into the next one, which is really looking at our open access Super Life Invest scheme, this one is self-directed investment, and you can see there that the switching was even higher than our KiwiSaver scheme and tends to run higher anyway on a day-to-day basis. So I suppose further evidence that really, depending on the number of people watching your account and how much oversight and you have with colleagues or other people around you, then that has an impact, as we see. If we then move on, I suppose in our data, we looked at words that were coming through our chat and whether we could sort of pick through this and find some leading indicators. Are there some things that people are starting to talk to us about that would give us some indication that switching is about to happen? And one of the fascinating things about this event is that really we've looked very hard, and there are very, very few leading indicators in terms of discussions, contact. You could say maybe that people checking their balances online, there was a little bit of an uptick, but sometimes there's a bit of volatility in that anyway without action on the switching side. One of the words we used there was change. We looked at other things as well. And really, you can see there that it's a trailing indicator that the switching happened, and a lot of people were thinking about changing but didn't switch. We still need to do a lot of work as an industry, I think, to obtain much better leading indicators of sort of this type of activity. If we just go through one more slide there, we can see with limited and incomplete data that there is some argument that the use of the word advice in our chatbot may have been a leading indicator by about 1 or 2 weeks, that we had a huge uptick in members asking whether we could provide advice, and that seemed to precede the switching that we saw. So that's the data that we saw. I think, yeah, sorry, that's my slide. So there we go, a few numbers around the story.
That's really interesting. Thank you for that, and interesting as well to see that you were looking at leading indicators. We'll probably come back to that later on as well. Before Henry will give us some color around how big those losses were, I just want to quickly stop for a couple of questions from the audience. One was around default KiwiSaver providers versus non-default. Now, I appreciate that's hard for the providers to answer. Gillian, any thoughts or any insights you would have on whether there's a difference in switching between default KiwiSaver providers and non-default providers?
Yeah, so we're doing some research at the moment. We've got a number of KiwiSaver providers participating just to share some data with us and help us be able to answer that sort of question. Obviously, the default member themselves is in a conservative fund, so they're not switching, but, good question around do default providers operate a bit differently to non-default providers? We're also exploring things like, did the advice make a difference? Did prompts make a difference? Did the type of communications? Take Jonathan's point that maybe, only, 94% of people stayed where they were, but was that because of all the really great communications that went out? What would have happened if you'd done nothing? So, yeah, just really looking to explore some of those reasons for switching, and that research is underway right now. We're doing a data gather, and we'll have results early next year from that.
That's great. We'll look forward to seeing some of the insights from that study.
No, just to add to one of the things I think was a key learning out of COVID, and Gillian would be too modest to mention it, but the fact that she got on 7 sharp, and the FMA came out and said, think about the long term, don't do anything, was incredibly helpful, because we are providers, we're a bank, or we're fund managers, or whoever we are. There's certain skepticism around when we say don't do anything or don't change, I think, from the investor public. So when the regulator comes out and says what we've been saying and backs us up, and that actually we saw a difference, we started to see that we were able to use what the FMA said, and that really certainly helped reassure customers. So I would advocate for more of that.
That's great. Thank you. And I might just save the other question for later on when we talk about solutions, and maybe let's go first to Henry to talk through some of the analysis he did on to what extent actually, what does it mean in terms of dollar figures to lock in a loss?
Thanks, Noel. If we could get those slides up, we can start looking at some of these numbers of the losses. So this one here is a map of the NZX 50 versus the switching that happened at Generate KiwiSaver. And as you can see, it's almost a direct inverse. So as the stock market plummeted, the number of switches went straight up. It doesn't show the number of switches going back from conservative to growth. That was happening post, and that was a very interesting phenomenon. But this is really just showing that how those losses happened. And I think what's interesting to note here is the bottom of the market was about the 23rd of March. It was down about 25% at that point, and it finished March only down about half of that, 12.5%. But the bulk of the switching happened below that line where we finished the end of March. So in terms of locking in losses, a lot of people were locking in 12.5% plus during that time period. So if we go to the next slide, we can see how that will relate to the value at retirement. And these are numbers that have come off. They're basically an average member, 30 years old, income of 65,000, and a balance going into March of about 35,000. Their KiwiSaver retirement in a growth fund is going to be close to 300K. And during March, if they had a move to conservative and locked in that loss of 12.5%, they're going to be off, just over $4,000, and that affects their value at retirement enormously if they stay in conservative. So not only do they lock in the loss from moving during March, but they lock in a much lower rate of return. And I think that's a key point. We need to make sure that we are, as providers, getting back in front of people and giving them advice. And we'll talk about that soon in terms of solutions. And then we also mapped, what would happen if someone took that loss and at the end of the March flipped back to a growth fund. And as you can see there, they're down 4,300 at the time, but by the time they're 65, that loss has doubled to 10,000. So it's all relative to how much you have when you go into it, but it's a loss that gets projected over time. And for the next slide, this looks at contribution rates. So the first column is 3%, second 4%, and the next one is 8%. As you can see, the losses that you sustain during the COVID sell-off or any volatility that we experience in the markets is far outweighed by extra contributions and more saving. And the numbers speak for themselves, that they really are significantly different. And I think that's really important. So the key messages that for me were, if you're moving, you are locking in losses. If you do lock in losses, it's never too late to move back. And then the real driver is to increase your contribution rates. So it's all about advice. Get advice, find out what the contribution rate is for you, find out what your plan is, and stick to your plan. And those are the slides.
Great, thank you, Henry. We'll definitely come back to advice in a minute. We had a question on switching behavior around whether people think it was driven by poor decision making, or whether people realized that they were in the wrong fund and then corrected that by switching. Jonathan, any thoughts on that? Did some people not realize how risky the funds were? Do you have any experience or any thoughts on that?
Not really. We didn't really sort of get any of that feedback at the time. What we did get after people had switched was an awful lot of people contacting us going, I wish I hadn't. And I made a rash decision. I was panicking. I wish I'd listened to what you said and actually switched back. So we saw much more of that than people going, I think I was in the wrong fund to start with.
Interesting. Hugh, any insights from you on whether it's about making possibly the wrong decision versus you were in the wrong fund from the start?
Well, certainly our chat data and transcripts show that there's a large proportion of members asking which fund they're in and what their investment strategy is and wording to that effect. So that might indicate that I suppose they're not just not sure whether it's the right fund, but actually not entirely sure which fund they're in to start off with, and that's probably the place to start rather than I suppose that fund choice. We also within Superlife have a life cycle option which allows people to I suppose go onto autopilot to some extent, because it means that when they're young they're on a higher proportion of growth assets in their allocation, and as they get older and closer to needing the money, then they go into a more conservative allocation. So it's interesting that just to see that I suppose people did stick with that strategy as well. We didn't see large numbers of people I suppose getting wobbly knees at the last moment and deciding that that was the wrong option for them. So I think this is another area where the industry should look at that life cycle option and just how we develop that over through the economic cycle.
Okay, great. Thank you for that, and thank you for the questions that are coming through as well. It's great to see some interaction. So we talked a bit about why people make the switch and what it means in terms of outcomes, and how many of the members make a switch. Now let's look a bit forward and think about what we can do to hopefully avoid people locking in losses. And we'll talk about 4 areas: education, communication, regulation, and also advice. And would like to start with education, and maybe Gillian, if you could start with some of your thoughts. Obviously that is something that is close to your heart as well, in terms of improving education and financial literacy. What are your thoughts on that in New Zealand in general, and more specifically regarding switching?
Yeah, so look, we do know that financial well-being, which I guess is the end outcome of being literate and capable, it isn't as strong as it could be. CFFC research released during COVID suggested that New Zealanders don't have a lot of resilience, so they don't have a lot of savings to fall back on. They tend not to know their KiwiSaver settings, so large numbers don't know what fund they're in, and potentially don't even know who their KiwiSaver provider is. And how to choose a fund, as Hugh suggested, is the sort of number one question that comes up. And we participated in the recent Money Week, and that was actually, far and away the biggest question was, how do I choose the right fund? And we saw that repeated last week in World Investor Week when we ran a webinar with Mary Holm. Lots of questions about how do I know which fund is right for me. Having said all of that, we don't expect KiwiSaver providers to be educators. We want providers to be helping people make good decisions. We want you to be talking to members in a way they understand, with plain language, at those points where they're making those decisions. So when they want to know what the fund is, help them with the information and advice if they want that, to be able to make that really good decision. And you'll see that's the approach that has gone into the KiwiSaver default provider tender. So we don't want this just to be a one-off. KiwiSaver lasts an entire lifetime, and we've tried to identify with MB those engagement points where people are most likely to be thinking about money, because that's the very best time to help them with some really good information. So I guess it's less about, teach them the ABCs of KiwiSaver, and more about, at the points where they're making the decision, how can you provide the right information, tools, framing, whatever it is that means that they can make a decision that's the best decision for their best interests.
Great. Thank you. Jonathan, what are your thoughts on education? And you sort of, I guess, already got a bit of I guess, a steer there in terms of what the FMA expects. But nevertheless, what are your thoughts around how we can improve, I guess, potentially financial literacy, and what role does a provider have to play in that?
Yeah, look, it's lovely to hear the regulator say that doesn't want providers to be an educator, because I can't. I'm not sure all these KiwiSaver members want to be educated by us. I certainly don't see it as our role to educate. Somehow, it's almost like a good teacher, isn't it? Like a teacher somehow get our children to want to learn. My daughter used to like Spanish, and then she had a bad teacher, and now she doesn't like Spanish. And you sort of go like, what are the things that we can do to get our members to actually really engage in something that's important? And we've got to just be really, I think, customer centric and really simple in the way in our language. And we talked about it before. Like, if you think about what was going on around switching, people were making some decisions based on really maybe not the greatest information. They were looking at a balance on their phone that was out of date, making a decision based on that number. And I, like, the analogy I had is the same time as like people were switching and KiwiSaver money was going down. I was in lockdown out with the rest of the country, and I bought 2 bottles of gin through Glengarry. And the experience of buying gin through Glengarry was I knew what the price was when I bought it. I knew when it was put in a box. I knew when it left Glengarry. I knew where it was, and it arrived to. I always knew all the way through the process what was going on and where my 2 bottles of gin were. And if I compare that to fund switching, people don't really know what's going on in the process. We don't really help ourselves. So I think simple things that other industries do really well that I think our industry can learn from is that how do we make some of this stuff really easy for customers to understand, and so they make the decisions that are going to be good for the outcome that they want. I don't think educating is the right thing. I just think having simple ways that we can get simple messages to people, simple understanding, I think will be the way forward.
That's great. That's a great segue into member communication as an option to help with the issue. Henry, what role does communication play, and can you maybe share some of the insights? You mentioned before that a lot of the switching occurred digitally, meaning probably without any communication. Can you just give us some insights on the experience in terms of when you were able to communicate, and more generally what you think the role of communication is?
Yeah, thanks. I think Jonathan touched on a very, very important point before, and that was when Gillian came out with her 7 Sharp episode and the article that was, stick to your KiwiSaver path. And I can't tell you how beneficial that was. It was phenomenal. We had so many people on the phones that we were able to talk to. We were able to talk to that story. We're able to say, it's not just us, it's the FMA. They're an impartial, trusted source of information. And that really did make people think twice. And so from the people who called in and the people that our advisors could speak to, 1 in 4 managed to stick to their plan. And we just don't have that opportunity when people are electronic switching. And the other part that was really interesting for us was the speed at which the sell-off happened and the level of switching rose was phenomenally fast. And we've got social media, and what we need in communications is consistent messaging across the whole industry. And it was really, really pleasing to see. And it was led obviously by Gillian, but all of the other providers were putting those stories in their newsletters up on social media, and you could see the weight of the consistent messaging was changing the opinion of the people on the phones, and so that was a key learning as well. So at independent, trusted sources, industry-led, could be CFFC, could be FMA. Those messages repeated through the industry by all of us, and I think that combined effort throughout communication channels through social media, newsletters, will get the message across. And there was a void after that initial sell-off, which was obviously everyone was at home, and so they couldn't do anything but look for more information, mostly on the health problem, but it was also about KiwiSaver. And we saw a huge uptick in webinars and people wanting more information about their KiwiSaver. So I think we need to, as an industry, look at in times of heavy volatility, consistent messaging, industry-led, and then a lot of information to fill the gap. Stick to the plan, and we should be able to get people to better results and better outcomes.
That's great. That gives a really good steer, I guess, for the industry. Have consistent messaging, and that's really good to hear that really helped. And I guess high praise for our regulators as well, which I'm sure Gillian is happy to hear. Hugh, what are your thoughts on communication and more generally engagement? There's this sort of, I guess, mix between, on the one hand, it's really great if people are very engaged. On the other hand, maybe people who, like Buffett says, just put it in the drawer and don't look at it are less likely to sort of make switches as well. What are your thoughts on communication, and what's too much communication, and when is the right time, I guess, to communicate with members?
Well, I suppose I'm firstly agree with Henry that you know, this volatility period, this crisis, was a great opportunity for innovation, and you know, we did see the industry really rising to the challenge with webinars and various things. I think it's important to note also that it's not just the product providers, the managers, the scheme providers who were involved here. I mean, we now have, I suppose, self-directed platforms, and we have various other participants in the market, and they all have their own communication channels. But what we noticed, you know, I think, as Jonathan mentioned earlier, you know, somewhere between around 95% of members didn't switch. And if we're defining that as having the right outcome, then, you know, I suppose they won. And we shouldn't overlook the fact that we can actually make things worse by stirring the pot, I suppose, more vigorously in times of crisis. So, you know, I think we need to be careful. And I suppose back to the earlier conversation, you know, if we think about delivering gin, you know, that's a mass customization problem, because not everyone wants to know where their gin is along the trail. The people who do want to know want to be able to find it out immediately, and that's and the people who don't want to know would be very annoyed if you kept reminding them every 5 minutes where it was in the process. So I think we, you know, I think we're in that age where every single member expects personalised and customised treatment, and luckily we're also in the age where the technology can deliver that. So what we're talking about here is identifying through the data who we're dealing with. And, you know, one of the big problems we've got is that the social license for this kind of data analysis is dragging a wee way behind our technological capability for undertaking that analysis. And what I mean by that is, I suppose, if we took two members and one of them we called up and said, hey, by the way, we've been tracking you online and we think you're about to do something ill-advised with your money. Out of those two members, one would try and slap us and the other one would shake our hand. So, you know, from a privacy and a data security perspective, as an industry, we need to bring our customers and members with us as we start to become more innovative in how we communicate and how we analyze and how we predict what is otherwise, I suppose, potentially irrational behavior. And that is the name of a book which I would recommend following on for anyone who's read Thinking Fast and Slow. Moving on to Predictably Irrational, I think is a good read in this space.
That's great, and some really good points there around, I guess, how much can we do that with how much can providers do with the data they have at their fingertips from individual members. The third sort of topic, and we probably don't need to spend too much time on it, and it seems from the Q&A that advice is really one of the areas that people are very interested in. But nevertheless, Gillian, in terms of regulatory, I guess, interference, do you see any point of saying, well, providers should make it harder for people to switch, or put in some, you know, breaks or pop-up windows that make it harder for people to switch? And is there anything where you think, like, given the numbers are so low, possibly not necessary to regulate, but what's your sort of view in terms of making it harder to switch, and is this something that the regulator would think about in terms of how they regulate the providers?
Look, I mean, any decisions on regulation would be for government, not necessarily for us, but you know, a bit of friction can help. We saw that when you know, things were a little bit harder to switch, if it's not straight away on your phone, maybe that just causes people to think twice because they've got to go to their PC to do it. You know, maybe the pop-up when you're making the decision that says, hey, you're really sure, why don't you take an RPQ first or something. You know, those sorts of things can act as sort of natural prompts to just help people stop and think. I mean, investing is not one of those places where you want investors to be able to exploit near-term opportunities, really. Certainly not KiwiSaver investors. So maybe putting a little bit more friction into the process could help.
That's great. That's interesting. Just in the interest of time, maybe let's now move on to advice. And we had quite a few questions on advice come through. And one is quite specific. Did the provider see an increase in advice provided or risk profile tools used? Jonathan, maybe I'll start with you. Did you see an increase in terms of people seeking advice?
Absolutely. Like we've got a team down in Makao who take calls that come in that get escalated from the contact center. They would normally get about 25 to 30 calls a day. They were getting over 300 a day of people wanting to speak to someone about their investments. So it just tenfold increase. And that's you know, the volumes of calls coming in has certainly fallen, but we asked continually to see people looking for advice, you know, in this environment of maybe you know, uncertainty, low interest rates. We're really actually probably on a wave of people wanting advice. And normally, you know, people don't normally walk into a bank and say, "Can I get some investment advice?" We're seeing that a lot every day of the week at the moment. So it has, I think, the whole COVID interest rate environment has certainly changed people's perception about advice, which is a great opportunity for the industry to be able to give more and more advice to people in bite-sized chunks, or you know, or however they want to get it.
Great. So interesting, to hear that there was a demand for more advice. One question was simply, is advice the answer? Maybe I'll pose that question to you, Henry. What are your thoughts on advice as being the answer to avoiding the problem of switching at the wrong time?
I think it's very critical. The problem is when these mass volatility events happen, it happens incredibly fast, and you do get a tenfold increase in the number of inquiries you get, and it's very hard to add a tenfold number of advisors to be there to talk to customers. So, you know, as an industry, we can look at other robo-advice options and how we do those, how we offer the advice up that can be scaled in these times of volatility. But as we've already pointed out, those people who go into it with advice up front generally stick to their plan more than the others that haven't had advice. They do have a plan. They do know what fund they're in. They do know that this is a long-term savings product, and they get far better outcomes. I mean, that's been shown across the FSC research and all the other research that has come out. And certainly that reflects what we were able to do on the phones. You know, if we're saving 1 in 4 transfers versus the online switching, which is not, then that's a good outcome for advice. So absolutely, advice is a big key to play in this, but we have to use technology to scale it because we just can't have that many advisors available on those days when things are selling off.
That's a great point, and there will be a session on robo advice later on in the week as well at the conference. Another question we had was, and I'll ask Hugh this question. You mentioned life cycle before. The question was, do you think that the availability of life cycle options would have reduced the level of switching? What sort of insights do you have from your life cycle product, Hugh?
Yeah, well, we're still analysing the data on that, so I can't give any specific examples or numbers on our particular life cycle option and whether we saw more switching. However, I suppose it is an option that the member, when they choose it, they're consciously choosing that option. And so they have at that point been educated to some extent on what it means to be in a life cycle option and what changes during their life, being the allocation to growth or income assets. So to some extent, it's a product that comes with an advice component in that product, and so I would go back to the previous question on advice and say, actually, one of the scalability challenges is to break advice into components and to break it in and to make it, to productize it, I suppose, to make a word. And within our industry, I think potentially the participants who are making the greatest strides in this particular area at the moment are the online platforms, where they are taking complex problems and breaking it into bite-sized chunks and serving it up to large numbers of people in a kind of a digestible format and through multiple channels. So maybe that is one of the options, that combining investment products with advice products in the way that we have with a life cycle option, that can be replicated in other areas of the market. And I'd encourage all providers to sort of work together and think about innovative ways of combining advice with investments.
That's great. Thanks you, and a lot of positive feedback on advice as a solution. Just conscious of time, we've got a really great question here to sort of wrap things up. Question to providers: what one thing would you do differently for your members in the next big market sell-off? Henry, I'll start with you.
I would have those communications, those simple, clear communications, almost ready to go as part of our BCP. We want to get them out. It is stick to your path. It is have that agreement potentially with the regulators that when we do see mass volatility, they will lead the charge, and then the industry gets in behind them. And I think if the quicker we can get on that wave of consistent, clear, simple messaging and get it out through all of our channels to all of our advisors and let it get through to the customers, the better. I think that's the key point for me.
That's great. BCP sounds really interesting as a concept as well, sort of preparing for the crisis before it happens. Jonathan, what about you? What would you do differently? The one big thing you would do differently in the next crisis as a provider?
Yeah, I probably would have launched robo-advice a bit quicker and have a tool so I can be, I've learned through COVID that an advisor can have a great conversation with a customer. How do I replicate that through robo-advice to 530,000 people? If I could do that, then I think we would have had a very different outcome for the people who made a decision, and also for the people who didn't make a decision, who maybe lost out on actually maybe increasing their contributions, making additional contributions and all those types of things. It would be robo-advice for me. Get that sorted earlier.
Great. Hugh, what about you? What's your, lesson learned, or what would you do differently in the next crisis?
Yeah, so, I would be really using our data much more effectively to accurately predict who we should be calling each day. I mean, if we had some really great data models that were working and trained much more accurately, we could have called every single one of those people if we'd known who they were a couple of days ahead of time. To Gillian's point, it's about providing the right information, but at the right time. So if we can call them on the morning that they're about to do a switch, just before they make their mind up, then that we would have succeeded. And I think we can get a lot closer to that with the data.
Great, that sounds great. Gillian, any final thoughts from you, both in terms of what to do differently and just generally in terms of the topic?
Yeah, so look, I think there's some really great thoughts here from the providers, and we'll be sharing some of those thoughts when we have our research as well. So we may have some additional ideas to throw into the mix. I guess that we just do need to acknowledge that people are people, and sometimes whatever we do, they will make a decision that maybe on the face of it doesn't seem in their best interests, but as Jonathan's example showed, you know, if they can sleep better at night, sometimes that is a good outcome for them, even if we may think it isn't. So I encourage you to do all those things that you're thinking about, and more, and I'll have the 7 Sharp producer on speed dial, yeah, but you know, people will still switch. There's still people, and this is a big topic, and it's tough, and it's really hard to get right for everyone.
Great, that's great. Okay, thank you very much, Gillian, Jonathan, Henry, and Hugh. It was really great to hear from you, from your experience, and also some really great thoughts on how we can tackle this issue going forward. To everyone that dialed in, I hope you found the session insightful, and I think the conference will be back tomorrow morning. And thanks a lot for dialing in, and have a great rest of the day, everyone. Thank you.
Fantastic. It is such a pleasure to have such leading discussions from across the sector on our platforms. Thank you to all of this afternoon's and indeed all of today's speakers. Great content drives great conferences, and superb content is something we're not short of here. All of today's sessions have been recorded and are available to all registrants to watch again in your own time. If you haven't yet had a chance to look at the sponsor and Tech Alley areas, I would thoroughly recommend it. There are all sorts of downloadable resources and contacts available to you as the audience. We hope you've had a wonderful day so far and that you're able to relax this afternoon, ready for another day packed to the gunnels with great content tomorrow. For those of you who have tickets for tomorrow, we will see you back here bright and early at 8 a.m. for the breakfast breakout sessions. Bring your Weet-Bix or your Vogels with avocado. The dress code includes pyjamas. That's one of the benefits of a digital event. Once again, if you have any questions about the event, please email events@fsc.org.nz and the events team will be in touch. I'm Vanya Thomas from Guardian Trust, and I've been your MC for day one. It has been a pleasure being with you all today, whether you're in your office, in your home study, or on the school run. Thank you to the team here in the studio, and have a very pleasant evening. E no hora.